you hosted our online investor forum. This event is hosted for your additional benefit for further discussion and clarifications, if any, on our performance. So at the head table today we have the Chief Executive Officer, Mr. Rajendra Tyagaraja, the Group Chief Financial Officer, Mr. Faizan Osman, and representing the NDB Capital Market Cluster, the CEO of NDB Capital Holdings Limited, Mr. Vajra Kulathilaka. I would also like to get your attention to the small investor docket that we handed over to you today. Just two important documents in that docket. One is the investor feedback form. We would kindly request you to fill it and return to us, as we very much value your comments. And also, we introduced this quiz last time, and we have continued it this time as well. So you can take it home, of course, and then probably send in your forecast by the deadline mentioned, and then probably walk away with an interesting gift. On that note, I would like to remind you that from the last time's quiz, we have selected the winner, and we will be announcing the winner at the end of today's presentations and the question and answer session. All right, with that, I will quickly run through the agenda for today. The CEO will begin with a discussion on the macroeconomic situation which prevail in the country, and he will discuss as to how it impacted the bank's performance. Followed by the GCFO, he will take you through the numbers in a more in-depth analysis. And of course, after that, we will open the forum for questions and answers, which, ladies and gentlemen, is your time. So on that note, we will call upon our CEO to begin the first round of presentations. Thank you.
Good evening, well, good afternoon, ladies and gentlemen. Welcome to the quarterly investor presentation of the National Development Bank. Again, thank you for taking time and being with us. I also recognize in the audience a few of you who were with us earlier, about 10 days ago, in the webinar, and it's so encouraging to see some of you coming back again here, despite already going through about an hour of presentation, a detailed presentation in the webinar. So thank you for those of you who have done that, and we hope that your time here will be well spent. And our aim is to try and clarify and give a presentation as with an open mind as possible. What I'm going to do is to, in the next few minutes, touch on where we see some of the opportunities and challenges from a macroeconomic point of view. What does it mean to us? And touch on maybe a very few indicators as far as the first 6 months are concerned, and then invite Faizan Osman, the Group CFO, to go a bit more detail on the numbers. So I guess for 2016, the first 6 months, from an overall perspective, credit to the private sector seems to be in the upward growth, reaching or nearing the 30% growth. I believe that the numbers in hand showed a cumulative growth of around 28%, despite the policymakers trying to moderate this growth to around 20%. And I happened to be at a forum between the new governor of the central bank and the bank CEOs, where that particular expectation was clearly spelled out. So I think reading between the lines, there is an expectation to try to reduce the perceived overheating in the economy from a private sector credit point of view. And that will naturally have an impact also for NDB itself in terms of its original aspirations for the full year as to where we started the year and where we probably see the next 4 or 5 months ending. Then secondly, in terms of domestic inflation, even though we have seen some emerging signs in the last month or so of it sort of tapering, but during the first 6 months, we saw it chugging upwards. And that certainly, from our perspective, had a challenge in terms of how we wanted to drive our consumer business and the retail business, and perhaps a reallocation of the retail portfolio in terms of the focus on products. The key take home there was, I guess, an increased focus on housing as opposed to your typical personal loan portfolio, something we consciously remoderated. And then also domestic liquidity. I guess the last, Niran Mahathir here, treasurer, I think in the last, at least in the quarter, we have seen domestic liquidity continuously on the negative numbers, ranging close to hovering around 50 billion per day. And we ourselves have been a fairly significant borrower in the short-term domestic money market, in terms of money market borrowings. And that itself has a price to pay, and we are mindful of that. And I think moving forward, in the next few months, there is certainly an internal strategy. Given the slowness in terms of the deposits coming in to keep up with the deal pipeline on the asset side, I don't think we can afford the luxury of continuing to come into the money market at this rate. So we will certainly have to moderate our lending expectations to balance the money market exposure with the asset liability mismatch. So that is a retooling of the strategy which we have internally decided, and in the best interest of the organization. So I think those were three important readings for us. And of course, along with that, the entry of the new governor of the central bank. So far, we have had a couple of meetings with him as an industry as a whole. I think he's still getting his feet entrenched into his new role. But we are very pleased to note that he, as we have known him from his previous role in the private sector and also his association with the chamber, continues to be a person who is willing to engage the industry. So that is a positive thing. I think he has already met the bank CEOs, and tomorrow he is meeting the treasurers of banks. So I think that's good to have that advocacy, and hope that we have an alignment of his vision for monetary policy for the country, which will hopefully be also aligned with the fiscal policy of the country, which is a very important combination. A few numbers. I was also commend this investor relations things we are having is a continuous thing we have been now doing for 3 years, and we've taken great pride in doing this during good times and not so good times. But the key thing here is to come out, articulate, and communicate to you a story, regardless of whether you have the sunshine or a cloud. And I think that persistency was very aptly rewarded recently when the bank was recognized with the Gold Award at the local CFA Awards for Investor Relations. And I must say a very big thank you to the finance and the investor relations team, which helped me to continue this persistency relentlessly, regardless of the variations in performance. In terms of an overall, I would just like to highlight or pick on maybe 3 or 4 numbers in terms of indicators before I hand over to Osman. From a relativity point of view, when we came in March at the end of the first quarter, some of you would have recalled that the bank, I think we showed something just under 600 million or 570 million after attributable to shareholders, which was a 37% drop in relation to the previous year. And what, despite the moderation as at the end of 6 months, what we are very pleased is the relative progress we have made during the last 3 months, which is very, very important. And there is a direct correlation to some of the strategic levers we have pulled from within to address some of those things. We still have an issue regarding the net growth in deposits to support our growth. But other than that, I think some of the initiatives have really started to pay, and I just try to highlight on a couple of those. If you look at the net interest income, these numbers are now entrenched here, so I'm not going to look at the presentation. Net interest income itself has shown year-on-year growth of 11%, and this figure was 4% as at the end of March. And that, to me, is a real reflection of the repricing in our asset book, which we embarked seriously from around February, March this year. And we are very happy that that is showing the results we are expecting. And we will continue to focus on balancing volumes with yields and pricing. So that's the commitment which we have for ourselves and to our shareholders. Secondly, in terms of overhead management, we have always said it's not control, it's management. During the six months, half year, the growth in overheads has just been 7%. This was 10% during the first 3 months. So despite opening 9 new branches during the first 6 months and having a revision in the salaries in April, we have still managed to curtail the overall operating expenses by 7%. The operating profit, which showed a 34% decline in the first 3 months against year on year, is still showing a dip, but it has come down to 19%. And that's where we see the gap narrowing month on month, which is the positive thing. Then, of course, as I said, the profit attributable to shareholders, which also takes into account the group company contribution, is still not where we want it to be. It's way below where we want it to be. It is 25% below last year. But the silver lining is this gap was 37% in March. It's come down to 25, and it's steadily coming down, which means that we are doing something in the right direction. It is not the type of sunshine we like to see, but it is certainly not in dark clouds. It's in the right direction. And I want to, in that perspective, touch on a couple of things. NPLs. The NPL ratio on a gross basis is just around 2.54%, right? It was around I think it has moved up by about maybe 5 or 6 basis points. What you need to see in that is there is a presentation which I think Osman will go in detail. There is a particular bar chart which analyzes the various sectors of NPLs. And I want to, because some of you were here in Q1, I'm very mindful of that, I want to attract your attention to 2 bars in that bar chart, which will be shown later. I know Sanjeev has already had that conversation with me on the way. One is in terms of the agri sector. The agri sector shows in absolute terms an NPA figure of 4.8%. That figure was 3.6% at the end of March. The difference is coming from one specific NPL of 198 million, which has gone beyond that 90 days. But this is not something we are concerned about, which is threatening the viability of it. I think it will come back. So it is not something we are worried. And secondly, the apparel and textiles sector. The bar has widened to 8.6% as an NPL in relation to what it was in March at 6.9. So if you wonder from an absolute point of view, it has grown by 1.5%, which could be a concern. But let me assure you, in absolute terms, during the last 3 months, the increase in that sector from an NPL point of view was just 43 million rupees, just 43 million rupees. The real reason for the jump in the ratio was because the portfolio contracted by 3.2 billion in the last 3 months. So it was a ratio calculation and not an absolute increase in NPLs. Also, in terms of overall balance sheet growth, I think on a year-on-year basis, the loans have grown by about 21% against deposits of about 12%, right? This is not what we wanted to see. I think we would like to see the deposits growing the other way around. And for the 6 months, what we have actually seen is the loan book on a net basis growing by as high as 11 billion against a net growth in deposits by just 6 billion. So literally half the loan growth has been funded from deposits. But what I am happy to note is the branch network in which we invested has brought in 13 billion rupees of new deposits in that 6 months. What we were unfortunate was we saw an outflow of around 7 to 8 billion of institutional wholesale deposits, which were very rate sensitive, which have gone out to competition, which is something which we know at the right time, if we have to, with the right pricing, we can attract. So the positive thing is that 11 billion net growth in loans has been anchored and supported by a 13 billion of retail-centric deposits, which is important for us. I guess from a numbers point of view, the number which you may all be wondering is the number of impairment. As at the end of June, the total impairment figure for the bank stood at 879 million rupees against a loan book of about 250 billion. Now, this 879 was in comparison to the same figure being at 712 million as at the end of December last year, full year. And if you look at the 879 and break it into two components, the specific individual impairment, which relates to individual loans, which I stress, accounted for 438 million. Out of the 879, 438 came in from individual. But during the last 3 months, the incremental figure was only 88 million. Only 88 million. Because some of you who were here in March would have recalled that we had a 350 million specific impairment which we made for 2 large loans. So the incremental impact has only been 88. Where we have actually had a challenge is on the collective impairment figure, which is as of today 423. Out of the total 879, 423 is collective. And the jump has been around 236 million of that 423 has come in Q2. And that comes with a combination of two factors. One is, of course, the validation of the economic indicators, which we generally tend to revalidate every quarter. And of course, the application of the impairment model itself, which is in accordance with the board-approved impairment policy, where we take granularity in terms of the behavioral pattern of the portfolio, and we make these provisions. One thing we are very mindful is that for collective impairment, when we make a provision, the same way like mark to market in a loan book, what goes down can also come up. So that is the positivism we have taken. We have taken it head on without trying to basically camouflage anything. We have taken it head on because it is based on a transparent policy which we have got ourselves internally approved. And we will continue to re-examine it every quarter. And if there's an upside, the benefit will come back to the P&L. So those are some of the key highlights I wanted to focus and bring to your attention. But in conclusion, I would like to say, moving forward in the next 4 to 5 months, the strategy or the focus will be to moderate the loan book and the asset book, given the fact that we are shackled by a need for greater growth in deposits. So we will focus, moderate the loan book. And secondly, we have around 313 or so billion of assets, which has grown from the high hundreds in 2013, which is currently giving a return at 70 basis points. We have had been able to demonstrate in the last 3 years to have squeezed this book to give as high as 150 basis points 18 months ago. So I think the team as a whole will collectively focus on improving that return on average assets by multiples of 10 basis points in step by step. Because we realize that while growing in volume is important, but squeezing and getting a much better yield or return from this existing 300 or so billion of assets itself. I think there was somebody who asked this question 3 months ago. This is a 4 billion plus after-tax company. Why can't you do it? Let me assure you, but let's forget 2%. If we do a 1.5% ROA on 300 billion, it's 6 billion, right? So that's where the focus is going to be, milking that and squeezing in terms of, because the cost structure we have got right, and the repricing is coming in the right way. You've just got to make sure that the pricing of deposits and keeping on topping up the deposit flow continues to come at a pace to keep up with our lending expectations. So with those opening remarks, I would like to thank you for your patience and invite Faisal Osman to delve more detail in terms of numbers.
Thank you. And you saw the CEO, he knows all the numbers by heart. I had to go through presentations. But before I get to the presentation, if I can have your attention for a minute, I just want to say something about the CFA award, which we won recently. We started this journey about 3 to 4 years back. Let me tell you, 4 years back, we were nowhere. And in 2014, we won the bronze. In 2015, we won the silver. 2016, we carried the gold now. And we are very proud of it because this is an award for disclosure, transparency of information, giving the right information to the investors. And I have to say a big thank you to my team, Kumudari, who leads the investor relationship. Smithini is not here. And I need to disclose something further more is that when we started this 3 years back, honestly, the leadership and guidance was given by our CEO. And actually, he guided us to where we are. And today, we are carrying the goal with his guidance. So that is the fact. But now the challenge is to keep this award. And how we can keep this award is basically what we need is your support. There is a feedback. Give us feedback how we are doing. And it's only with your feedback we can progress. And to be honest, if somebody wins this, it's fine because it's good for the capital markets, it's good for the salary, but we will make every effort to keep the gold award. Well, having said that, I'm really not here to talk about the CFA award. I'm here to present the first half June 2016 numbers. So, good afternoon, ladies and gentlemen. Thank you very much for coming here, being here. Let me start the presentation. So this is a snapshot of the bank's performance for 6 months. So what we basically done is broken the performance into 4 quadrants. Profitability, which will show you the P&L, financial position, basically the balance sheet, efficiency, the capacity, business capacity ratios, which gives you the agility, shows the agility, the flexibility, the ability to do more business or how you can grow. So basically, this is a snapshot. Let me start with the operating income. You see a growth of 6%. It is a kind of a moderate growth. There is a separate breakdown slide. What happened there, we'll discuss detail. Basically, it's a stable growth. And last quarter also, we had a growth of around 6 to 7%. Operating expenses have gone up by 7%. But here we have made progress because at the last quarter, the growth was 10%. So from 10 to we have managed to bring down to 7%. The profit attributable to the ordinary shareholders is slightly over $1 billion. And it's down 25%. As CEO explained in detail, we were affected by the collective provision there. We look at a little more details in the income statement. But while the profit is down by 25%, the good news is that we have been able to reduce this gap to 25% from 37% reported at the previous quarter. So we have progressed here. In terms of the balance sheet, total assets have grown by 16%. I guess the market also has grown by 16%. Total loans, that is the customer loans, have grown by 21%. I believe the market has grown by about 20%. And maybe we are a bit ahead of the market in terms of customer loans. Deposits at 12%. It's a moderate growth, to be honest. That's not a figure we are happy with, because what we really expected was to keep tandem along with the loan growth. But that was a challenge which we confronted in 2015 or during the period, the last 6 months. In terms of efficiency ratios, the cost to income ratio is around like 53.7. Is something which you should see coming down with the growth of our revenue. Net interest margin of 2.7 compared to the industry of around like 3.5, 3.6 is lower. But the good news again is that we know the industry margins have been under pressure, and we've been able to sustain or marginally improve. What we reported at the last quarter was 2.6, so there's a 10 basis point improvement. Return on average equity, I know you're not happy, we are not happy, nobody's happy with this ROE of 7.6%. Again, it is down because of the profit for shareholders were down, and there was squeeze in the margin. So it's at 7.6, but this is a figure we are expecting to double over the next 2-3 quarters, and you should see improvements there. In terms of business capacity, the loan to deposit ratio is at 118. It has moved up. Again, this is a ratio which we want to bring it down to around 100. And the bank's strategy is to grow the deposit book at the same tandem or at a higher pace than the loan growth. Capital adequacy ratio at 15 at a group level remains strong. The bank's liquidity position is very strong. The regulatory minimum is 20 and we are at 21. It has always been strong. So basically a snapshot, I call it a helicopter view of the bank's performance. So in summary, what you see is the profits have come down by 25%, while it has, and mainly because of the provisioning, while it has come down by 25%, we have improved from 37% reported at the last quarter. Let me take you to the income statement next. This is the detailed P&L. So what you see is net interest income has grown by 11%. It's a moderate growth. Again, the good news is that at last quarter, the growth was only 4%. So we have grown to 11%. And the reasons for the growth is two aspects. One is that we have revised our pricing. And two, we have also shuffled around and moved our asset growth to more profitable areas. So this has basically paid off, and we managed to grow by 11% from 4% reported at the last quarter. Operating expenses has gone up by 6%, and that's despite we opening 9 new branches. We have recruited more than 125 people during the period. I think 6% is a moderate growth. It's acceptable, and the figure reported at the last quarter was 10%. Impairment is a huge increase of 304%. I'll see you explain in detail. There's a growth of 661 million, and out of this 661 million, 400 million is for collective provisioning. And again, this is not restricted to a single customer or a particular segment. It is a collective provisioning, and there's no cash flow impact. And if we do well in our recoveries, these are figures which can be reversed in due course. Operating expenses is up by 7%. The figure reported the last quarter was 10%. And overall PAS is slightly over 1 billion, and has explained or discussed earlier, it's a reduction of 25%. We are not happy to see reduction in the PAS, but at least we are contented that this has reduced from 37% reduced reported in the previous quarter. Let me take you to the net interest income. What you see is a growth of 11.3%. While this growth of 11.3 is moderate, and we have done better compared to the previous quarter growth of 4%, honestly, our expectation was over 20%. So you may ask the question, so what happened? What really happened was that you saw in our previous slide, our advances grew by 21%, and whereas the deposits grew only by 12%. So basically, there was the advance growth from year on year was around like 40 billion, and the deposits are around like 20 billion. So there is a funding gap of 20 billion. So of this funding gap of 20 billion, 10 billion was funded through a debenture issue which we did last year, and there was a gap of 10 billion. It should have ideally come from deposits, but the market liquidity was tight. We really didn't chase after high-cost deposits, because our strategy and our belief is that we want to have core deposits at a low rate, grow the CASA base. So we really had to depend on market borrowing, and the interbank rates also went up. So that really squeezed the margins, and interest expenses went up by 38%. So that's really what happened. If that didn't happen, maybe we could have got this figure to 20%. So how do we correct this? how this can be corrected is to grow our deposit base. And that should improve our margin in the coming months, in the coming quarters. This slide depicts you the non-interest income. What you see on the top, the fee and commission, as reports a moderate growth of 2.8%. Now this is at a group level, but if you really see at a bank level, we grew by 15%. So what happened here? Basically what happened was the group income from our capital market cluster was lower compared to the previous period. I believe this the income from capital market cluster is more based on the market opportunities available. But if you see the core business, basically fee, commission, LC, guarantee, it has grown. It's going up. The corporate, project finance, core business is growing. So that's why you see at a bank level, this has grown by 15%, but at a group level, it's 2.8. The next figure, 456 million, which is the gain on trading. Again, there's a dip of 2.5%. I think we all know during the period, during the recent past, the opportunities available for FX trading was limited. So you see a dip there. The other operating income basically consists of three elements. The profits from ALM, revaluation of the foreign currency book, which is basically our capital, and third, the dividend income. Again, these are basically one-offs, and it was lower compared to the previous period, and as such, you see a dip of 18%. So, in a summary, the non-interest income is down marginally by around 2%, and the reason for the reduction is because of one-off not available during the period. But if you really get behind the numbers, you see that our core business revenue is growing. Okay, let me take you to the operating expenses. Bulk of the 3.5 billion, bulk of the operating expenses, 1.8 billion, or more than 50% is for personal expenses. Now that has grown by 4.4%, below 5%. And I think that is acceptable given that we have opened 9 new branches. We have recruited 125 new staff members to support the expanded growth. So a growth of 4.4% is moderate. Depreciation and amortization is up by 17.5%. It's not a large amount. It's not a big amount, 240 million. That's again because of the 9 new branches. Other expenses is up by 8.3%. This figure was 12% in the previous quarter. And again, I think taking into account the current inflation, I believe it's the average is around like 4 to 5%, and the growth in business, it is acceptable. So if you see, the cost base has increased by 6.7%, and we believe that we have managed the cost well. The cost to income ratio is 53, around 53, and this is something which should come down along with the growth of our revenue base. Let me also tell you that in terms of cost, we have a very, very efficient procurement management system where the team goes through a very transparent tender procedure where they ensure they get the right product at the right price at the right time. And apart from that, internally, we have a separate team focusing on cost management, and they keep on challenging the business to better manage costs daily. Well, the balance sheet. If you look at the balance sheet, what you see, this is for these 6 months. What you see is a growth of 2%. And I believe the industry has grown by about 4%. So if you really ask, is it in line with our appetite? No. We would have liked to grow above market, but we really had to curtail our growth because of the limited deposit growth of 12%. If you see from the balance sheet mix, from the assets, 69% of the assets are loans, and from the liability, it's 60%. So if you see, there is a funding mismatch. This is the funding mismatch I discussed earlier. So this is about like 9% funding mismatch. And this 9% really translates to around like 9 to 10 billion of liquidity mismatch in terms of local currency. So when the rates go up, there is a squeeze in our margins. And this is what we have to fix, and this is what we are working on. In terms of foreign currency, our loan book is around like 22%, and deposits are around like 24%. So we really have excess liquidity here. Loans and advances. This is an area where we have done quite well, although during the year, the growth is 5%. The compounded average growth rate over the past 5 years is 26%, and on year-on-year basis, it is 21%. In terms of loan growth, you see that it's growing across all products. Retail has grown by 30%, project finance 44%, corporate just near 4%, because our focus has been to drive more of retail and project finance business because of moving towards better margin products. Certainly, that has a kind of a impact on the NPS, because the NPS relatively in retail and project finance are higher, but it's a trade-off, and we've been focusing on growing the retail and the project finance book. And we believe that this strategy should improve the balance sheet margins in the due course, and that's something the CEO also discussed. The focus is to improve our ROE, and this is one of the internal strategies what we are using at present. This is very important, the asset quality. The NPLs are at 2.5. We are below the industry. But one may ask the question, yes, you are below the industry, but the industry has come down and you're almost flat. The reasons are two. One is that, as I discussed previously, we've also been shifting our asset growth towards more retail, SME, and project finance compared to the traditional corporate, where the NPLs are relatively higher. We do believe in the long run, this will be productive, attractive in terms of enhancing our margins in the balance sheet. So that's one reason. The other thing, if you look at the industry curve, we also know that there are one or two banks which had large NPLs, and they have been restructured, and that's one reason it had a sudden fall. So in a summary, NDB's NPL of 2.5% is well under control, and it's within our board-approved risk appetite. In terms of impairment allowance, we are at around like 2.5. We are in line with the industry in terms of the impairment allowance, or you call it the credit cost. But the good thing is also, or one may interpret that we are a bit conservative here, because if you compare with the industry NPL, our NPL is much below the or below the industry, but in terms of the credit cost allowance, we are far. The portfolio is well diversified. We don't put all eggs into one basket. We have a very good risk management process system, which ensures our portfolio is very well diversified. This 21% on retail is again diversified into various sectors. On the NPL, I think the C in detail, the agri 4.8 and the textile 8.6. This actually, although it is 8.6, the actual growth here is 43 million, but it's the amount here, our exposure is small. So there is no problem here. Let me also remind you here, I think most of you all know that during the period, somewhere in June, the Fitch came and downgraded several banks, and NDB's rating also was downgraded from AA to A+. And the reasons quoted by Fitch for downgrading are three. One is the aggressive asset growth. They were concerned about the profitability and the adequacy of capital. So, in fact, they commented on the quality of our asset, and they had said that NDB has a good quality asset book. Because when you say there is a downgrading, most of the people think it is the quality of the asset book, but here it was not that. It is because of our aggressive growth, concerns about whether we will have enough capital for the future. The rating agencies, they not that we are arguing with them. We accept whatever they have given us. But I must tell you, rating agencies, they don't like growth. They don't like a very high aggressive growth. But I know you investors like it. For asset quality, let me take you to customer deposit. Year-on-year growth of 12%, moderate. The industry grew by 16%. You really ask, we are not happy. We had the option of going behind high-cost deposit. That's not a strategy we wanted to take and not likely to take. Our strategy is to grow our core customer base through products. The CASA ratio right now, 8 plus 16 is around 24%. Now, compared to the industry, I think it's over 40%. We are at 24%. And the reason why we are at 24% is we are relatively a new bank, less than 40 years, where some of the other banks who have been like almost 100 years, they do have a ratio of over 35 or some at 40s. But the good news here is, now these are the matured banks. You cannot go beyond 40. There's a limit where you can grow. Whereas for NDB, we are at 24, and we have the opportunity to take this to 30 or to 40. Medium-term vision is to take it to 30. And if we get there, our margins will certainly improve. And we believe that the current position gives us a competitive advantage over our competition. So all what we need to do is to grow our CASA base, and that should improve our margin, and we have that opportunity in hand. Capital adequacy, we are at 15 at a group level. At a bank level, we are around like 12.5, and the leverage is at 11 at group level. The reality is that we know we can do business to around like 14, 13, 14. There is room, but as the rating agencies suggested and questioned, this is an area where it can be challenged. So that's why the CEO, in his remarks, what he said was that we will undertake moderate growth unless we see infusion of capital. Well, investor ratios. This is your slide. This is your slide. I know where your eyes goes straight. It is the ROE. We accept the ROE of 7.6% is not acceptable. And certainly, this is something which we are working on through improving our margins. We want to take this to a double growth. We are looking at 15% plus in the short to medium term. And again, this was hampered because of the reduced margins and the very high collective impairment provision which we have to take. So these are factors which can be reversed. The other factor is the price to book value. Probably because of this situation, the share price is trading below 1. I guess below 1 is quite attractive. Another element which I want to show you is, I don't know whether you see the book value has consistently increased, the book value. There was a dip, but I'm also aware there are some banks which show like very high profit, but the book value is coming down. Why is that? Because they carry a lot of AFS losses, which is not the case at NDB. The book value is going up. So I think this is something which should strike an investor's or an analyst's eyes. Fine. The final slide, I put this because I was talking to one of my colleagues, Sudeepa, and I said, what should we talk to investors? And she told me that, listen, don't talk about history. All what they want to know is the future. So here is the future, and the CEO already told what the future. And let me summarize in terms of a few strategic levers. We gathered 6 years, improve margin. Certainly, that is very high on our plate. Current margins are around like 2.7. We want to take it to at least 3 in the short to medium. So that's increasing by about 30 basis points. And if we are able to increase by 30 basis points, that should kick in another ₹1 billion to the bottom line. Manage costs better. Our cost income ratio is 53.7%. We believe that we can bring it to below 45% when our income levels go up. During the year, our cost went up marginally by 7%, and that's because of the BAU, the business growth, 9 new branches, recruitment of 125 people to support the business growth. But this is also an important priority for us. Focus on risk management. This has been always there at NDB. I mean, irrespective of growth, our focus, we will not lose our focus on risk management. I know the industry respects us for the strength we have in terms of our risk management. Yes, we will grow, but not diluting our risk management focus. Governance and controls, again, is extremely important to us while we grow. And this is another area, especially our DFIs, respect NDB for the very strong governance and controls we have. So while we continue to grow, while we continue to improve our margins, we will not lose focus on governance and control. Building leadership talent, it's all about people. In an organization, there are some key elements which is very important: capital, technology. People are our most valued asset. So we are internally focused to groom our people to take into leadership positions while we grow our bank. And finally, while we make money, we also want to contribute to the society. We want to be good citizens. And let me just tell you one or two what we have done recently. In May, when the floods happened, NDB Bank and NDB staff was the first to reach those affected people in several areas. We work along with the Chamber of Commerce. I know it's not only NDB, but many corporates and many individuals were engaged in this. Another thing what we are doing is we are currently working on something like, it's a health problem, chronic kidney disease. There's something called chronic kidney disease. And apparently every year more than 6,000 people die. And that means, about 15 to 20 people die a day. And even while we talk, maybe there was a death in this country. And this is apparently a disease which can be cured if you detect early, and it can be prevented. So what NDB is doing is that it is targeting to screen at least 100,000 people in the country. And this is one of the CSR initiatives, what we are doing in the country. Even I didn't know that there is a disease like this and it can be prevented. So I myself, I had decided that I should do a check-in. Otherwise, you have to go through a dialysis. And if you do that, it apparently costs 35 to 40,000 each, and many people can't afford it. So it's not only about making money. There are various other CSR initiatives, environment initiatives we do at NDB Bank. So that's the end of my presentation, ladies and gentlemen. Thank you very much for hearing. And I think next is questions and answers. So the forum is open to all of you.
Thank you, Osman. Ladies and gentlemen, the floor is certainly open for questions and clarity. Please identify yourself and direct the question at one of us, and we'll try to clarify whatever things you have.
Hi, my name is Sanjeeva.
Yes, Sanjeev.
I have actually two questions. One is on collective provisions, the rationale behind that, because despite other systemically important banks reversing some of their collective provisions during the quarter, to name like Commercial Bank and HNB, what was the rationale behind NDB increasing collective provisions? And I'll answer that, ask the other one after.
Should I take the first? So you see, the policy which we developed is based on a model which we have engaged through the board governance structure, the IRMC, and the board. And regardless of the peers, what we have done is to be consistent in the policy and adopting the policy without changing assumptions. And I think somebody did ask that question. You would have been there at the webinar when somebody, one of your peers, asked that question, whether we have changed the assumptions. No. So the whole purpose behind that is, yes, during not so good times, you build the resilience, and then as two things, as the recovery patterns get better, you reap the benefits. And secondly, also, in the overall journey towards getting granularity in the analysis of the loss given default and the PD, as you are able to get further depth and granularity in the data you have, you are able to get a better result. And that's a continuum. So at this point in time, what we have adopted is using the formula which we have in consistency with our policy, and there is no change in that. But certainly what we are doing, and I think there is an opportunity in the next 2 quarters, is to further examine that the analysis which supports the granularity in terms of the data which supports this calculation. And if there is an opportunity to benefit from further granularity, we certainly will do it. And if and when we do that, of course, we will disclose as to why we have that clarity. Because today it's not only about changing formulas or assumptions, it's about also having equally strong assumptions disclosed to an intelligent reader in terms of, so that you can then compare apples with apples. So certainly that is an onward conversation and a journey which we are pursuing. But if and when we do that, we will also come out with an equal strong statement about why we are doing it. Also, you want to
yeah, let me explain to you statistically why the collective provision went up on the collective impairment. Because the collective impairment is statistically calculated the expected loss, which is the LGD, EAD into PD. And the collective impairment, you can use 2 models, which is the net flow rate and the probability of default model. So we basically use both these models. And what happens is that if you have individual write-offs, your LGD factors goes up. Your LGD factors goes up in the model. So it's automatic. So when the LGD factors go up, your collective impairment also goes up. So that's what happened to us recently. But the reverse is possible if we make some recoveries on the specific. Then the LGD, the PD factors will also go down, and we should see reversals in the coming quarters. But that's how the model is. Once you use the model, that's how you have to practice it. You can't change. So we have applied a consistent policy.
Thank you on that
question.
Yes, on deposits, actually, the next question. What is your strategy to retain some of these institutional deposits? Because I mean, if you look at some banks during the quarter, to name one bank, actually, Commercial Bank has increased the cost of funding despite other banks not aggressively. Other banks were also there, but Commercial was the one that increased the most. So I'm sure these guys must be capturing some of these institutional deposits. Do you plan to have a strategy for that, or you're not interested in these guys who are asking for higher rates?
It's not a question of not being interested. It is a question of intelligently balancing the need to pay a premium like that against the promise to better improve the margins on the asset book. And I think that is a fine art. I don't think any 2 banks or any 2 branches will be able to do that consistently. And I think one needs to take that call as to what is more important to the bank as of today in terms of a sustainability in the model and pursue. See, maybe one or two of those larger banks, as you mentioned, may be able to take that call because of the scale being much larger to be able to do that. But when you're trying to grow a moderate balance sheet to get to that next level, one needs to also be very careful about the tail effect of repricing liability. So then that is the intelligent call we constantly have with ALCO. So it's not a bi-weekly thing, it's actually a daily decision which we have. And it's a very painful and a tough thing to let a deposit go. We are mindful of that. But I think the internal decision which we took was to defend the granular retail SME-centric deposits, which also come through an association of a more sticky relationship than looking at the the deposit which goes out for a half base, 50 basis points, because for the same 50 basis points, you can attract it when you need to. So yes, selectively we will continue to attract those on a need basis, but not just go after it. The focus is, as I said, bring in more and more on the retail side, which we have done, I think, in the last 6 months. But we can do much more. We have to do much more. So I hope that gives very clarity. And that was the purpose of also opening those 9 branches. And I think you have not asked that question, but I think I owe it to you. When you look at those 9 branches, the new branches, even though the overall CASA is around 20, 23, 24%, those have given the results we are looking at. They are showing more towards the higher 30s and 40s. So that strategy is working. But of course, given the challenge in terms of the deposit growth to meet this loan growth, we will also have to intelligently manage the further branch growth. When we started the year, we were looking at maybe 20 branches, but we have already opened 9. We may look at another 5 or 6. So it may not be 20, it may be 15. And that is something we have to do intelligently and responsibly. But those approvals are anyhow there. We can always scale them up at the right time.
And lastly, I would like to know the NPA percentages of SME and microfinance related advances.
See, the microfinance book is probably around 30 to 40 basis points of the book as a whole. So it's a very minuscule thing. And all I can tell you is if I look at the new microfinance as part of this management team, which came together in 2013, all the, or literally I would say more than 90-95% of any microfinance which we have done is not township based, it is really village based, and it works really on cluster lending, group lending, and it has a value chain link. So the absence of security is supported by cash flow. That's been a very positive impact for us, but it's still very minuscule. On the SME side, I would say it's around less than 4 as of today. Yeah, 4.
Thank you.
Okay, as there seems to be no more questions, we'll close the question session. And as promised at the outset, we will now move on to a more exciting item, that is to announce the winner from the quiz which we posed to you all from the last Investor Forum. So the quiz, the challenge was to forecast the average weighted fixed deposit rate as declared by the Central Bank of Sri Lanka on a monthly basis for the month of June 2016. So the actual rate for June was 8.64%. We actually received an encouragingly large number of entries. And out of that, one entry came really close to the actual figure. It actually varied by only 4 basis points. So it was a forecast of 8.68%, which was sent in by Mr. Vidura Velatantri of JB Securities Private Limited. Do we have him here with us? Okay, so Vidura, will you walk up, please? And we have an exciting gift for him. That is a gift voucher for two from California Grill Hotel de Aladari. And to hand over the gift, I kindly call upon our CEO, Mr. Rajendra Tyagaraja. Okay, congratulations, Vidura, once again. So yes, you all have the quiz sheet for the next time as well. So do send in your forecast. You might be the lucky winner next time. On that happy note, we'll call the forum to an end. So thank you, ladies and gentlemen, for being with us. We now invite you for refreshments and networking, which is hosted just outside this hall. Thanks a lot and have yourselves a great evening. Thank you.